Let's break this down further with Katie Stockton, founder and managing partner at Fairlead Strategies. Katie, first of all, you're looking at some of the key levels in the Treasury yield market and as to whether this fall in yields is going to continue.
Well, I think it will. Obviously, a downtrend has been in place in yield terms for some time now, and we saw the 10-year Treasury yield dip below that very psychological support level of about 2%. The next major support for 10-year yields is around 1.4% based on the 2012-2016 lows. And, of course, at the same time, you're seeing breakouts in related ETFs like the TLTs, or the 20-year bond fund ETF there. So that breakout, to me, if it's confirmed next week, then we can, again, set our sights back on those levels from 2016, which are significantly higher, I think, in the realm of about 5 to 6% higher.
What's that going to do to stocks? How do you see that relationship unfolding?
Well, I'm watching, of course, the S&P 500 very closely. I like to look at them independently, and then, of course, things kind of come together that way, and that kind of keeps me honest in the way I look at things. And when I look at something like the SPYs or the SPDRs, this SPDR ETF, still have an uptrend there on an intermediate term basis. This is a short-term pullback, in my opinion. You're seeing the SPYs dip below their 50-day moving average, and I think that's scaring people, and reasonably so. And yet the momentum loss there is really still only short-term, and we've already gotten the first short-term oversold condition since early June. So I think as early as the middle of next week, we'll start to see some stabilization and certainly a loss of intraday downside momentum that will then preserve the intermediate term uptrend and even lend us a buying opportunity in stocks.
Michael, when you look at the yield on the S&P 500 relative to what's available in the Treasury market, does that TINA argument, there is no alternative, resound louder today than it ever has?
I think it does, absent the credit issue. I really agree with what our guest said, and I think, yes, that you can certainly look at stocks as a better alternative, because now the yield relative to the S&P yield is now basically the same as the 10-year Treasury yield. I will say, if you like the idea of buying a 10-year Treasury, consider buying utilities, because you can get a better yield, you can get better tax treatment, and we actually still think the fundamentals on utilities is pretty good. So, we like tech.
I've never heard anybody talk about the fundamentals of utilities.
I have said it on the show numerous times, but no one ever cares. But, we've overweighted them for, now about a year and a half, because I think the barbell strategy does make some sense here. We know secular growth is where all the action is, but on days like today, particularly as you noted, with utilities are leading.
You were just advocating for profitless IPOs.
Yeah, well, I'm beginning to see that maybe they're
one day
going to be
the same yield as utilities. It's the banks, the big banks at least now.
Yeah, different story only because you've got a credit risk situation there, and I just would rather not duplicate my risk. I do fear that the credit issue could be the issue that takes us down, and I just don't think it's worth the low growth prospects of the banks to do that. But, others have a different view.